The mighty, mighty pound. Look at you all. Look how many people are here for tonight's show. Some of the regulars, some new people, some new faces. Everybody's all mixed up. Mike Waller. That's right. The Pounders. I see you. Cliff, Sam, Sean. Great to see everybody tonight. Chris Hayes, Francis, Mitchell, Rachel's here. Jay Luther's here. We're going to have so much fun tonight. Thanks to everybody for tuning in as usual. Market actually went up today, so that was fun. Before we get into tonight's show, we're going to do two things. The first is Crane Shares is sponsoring What Are Your Thoughts this evening? Michael, a couple of words about Crane Shares.
Yeah, I'll give you some words. Did you know, we've hammered on this dozens of times now, K-Web, which was an abomination in 2021, bottomed in March.
It's beasting.
Way before our market did.
Yeah.
So what's the opposite of the canary in a coal mine? That's what this was.
Well, this is like the Peking duck in the coal mine, but like in a good way. I don't know. Listen, this thing's not hurting anymore. So I guess that's nice to see, and we could say that about a lot of tech stocks. I also wanted to remind you guys, if you're on Twitter or not on Twitter, the writers and bloggers and content people at Ritholtz Wealth all contribute to the Compound's Twitter feed, which is at the Compound News. But a lot of people don't want it on Twitter. But this is like the best stories of the day that we're putting out there. So if you want the email version, there's a link below us. You could subscribe to the nightly roundup. That's an automated email that goes out with all of the stuff that we link to on Twitter that day as a unit. So it's pretty cool. It's a lot of curation for you. We really just link to the best stuff. So check that link out below to subscribe.
Speaking of Twitter, I saw a take today that if Elon is right about the bots, then actually Twitter Twitter is more valuable because its earnings per real user are way higher than what we've been led to believe.
Where'd you see? I saw that too.
I just saw it fly by. I don't know who did it.
In other words, like, let's say they're bullshitting and 20% of the users are fake. That means that they're actually over earning with the 80% that are real. Yeah.
That was good. That was cute.
I don't think it's getting anyone anywhere.
Here's where we're starting, Josh. To me, one of the most important questions in all of finance and what millions of market participants are trying to do on a daily basis, both short-term and long-term, is figure out what's priced into the market, stock, asset class, whatever, and do they have a different view that they can capitalize on? And that's the name of the game. That is the whole name of the game, right? What's priced in.
Yeah, not just now, but always.
Yeah, always. Not just
you're smarter than the market. That's what you wake up thinking about. It's what you go to sleep thinking about.
All right. So this was a Zero Hedge premium article. So I did not get to read the whole thing because I subscribe to a lot of Substacks. This is not one of them. Goldman Trader. The top client question this week was, why did the market not go down in the face of incredibly worsening data?
Ooh, that's so bullish. That was the most common question asked amongst Goldman traders? Where did that even come from?
So over the last
that's bullish as shit.
The last month, the news has just gotten worse and worse.
Yeah.
And I think the bottom started in earnest, which is I've said that phrase twice today. I said it on the podcast earlier, not sure why. On CPI day, 9.1, stocks got pummeled pre-market. I don't know if they closed green, but they closed well off the lows.
You pointed out that day that I don't think the market closed green that day, but a lot of stocks did. Financial stocks did, which was kind of notable.
And then, then we got some follow through. The next day, same thing. They tried to sell them. They couldn't. Then we got banks reporting earnings, really not good. And we had the bank index have its best one-day report since May 2020. So my point is this. You only find out what's priced in when everybody else does. You might have a view, but you really only find out when everybody else does. So, for example, we'll get into Netflix tonight. But Netflix in Q2, for the first time in a decade, reported that it lost subscribers, right? Instead of adding subscribers. The stock was down 30%. I can't remember. It was just, nuked. Today, Same thing. Netflix reported that it lost 1 million subscribers for now, the second time in a decade.
Yeah.
But,
well, we're gonna go back to
I'm just saying.
Yeah.
So we'll get there.
Lockheed Martin is a really good example. This company reported this morning. LMT. This is a defense contractor, aerospace company. They had a bad quarter and they guided lower, and the stock went up $3. And it looks like it's up even more in the after hours. And there was nothing about what here. It started off the day down, bad earnings / sales guidance, et cetera, et cetera. But like if you look at an intraday chart of Lockheed Martin, you see that there really wasn't a lot of appetite to sell it right out of the gates from the open, and it just built all day. And if that's going to be the new pattern of earnings season, where the sellers just can't get it going, and you don't even need a lot of buyers to show up if that's what's going to happen.
It's early, but signs are looking good. So let's throw up this banks since earnings chart. John. Not great earnings. In fact, terrible earnings.
Yeah.
Terrible earnings. Double-digit declines in net income for everyone. Investment banking revenue collapsed. I mean, just not good. Not good stuff. And it's not as if the outlook was rosy, right? Jamie Dimon, Wells Fargo, Morgan Stanley, chief executives, also the same thing, that actually things look fantastic right now. If you were just in a vacuum, you didn't have any access to news, and you just looked at like credit and loans and all that sort of stuff, the consumer looks great, corporations looks great.
Right. But so here's the difference. Last October, JP Morgan was like $175 a share, and now it's 110. And then they put out an earnings quarter where they suspend the buyback. They don't raise the dividend during the stress test. They don't give you great guidance going forward. They set aside more money for losses. You're really not getting a ton of help from the yield curve. It inverted 2 days before they reported. And you know what? It was enough for the stock to stop going down.
Yeah, but JP Morgan's down 35%, and apparently, evidently, that was enough. But the point is, you only knew it was enough on Friday because
you don't even know until today, really. Right.
In Q1 or Q2, where the hell are we? In Q2, what we saw over and over and over was all of these teledocs of the world down 78% going into earnings. Clearly, they're pricing in catastrophe. Oh, yeah? Not enough. Stock's down 27% the next day. So you really don't know until you know.
Well, I also think there's a really sharp dividing line this year where enough is priced in and where it's not. And I think where enough is priced in is companies that were already selling maybe at a market multiple, at a high multiple, but not the 50 times sales crowd, and certainly not companies that haven't figured out how to earn money yet. Like that seems to be a very harsh dividing line, because when I look at the unprofitable tech basket, those stocks don't look like what we're seeing with Lockheed Martin and Citigroup and Goldman. Those stocks still look like fucking death. And I don't think they're going to get that same treatment if and when they report their lack of earnings.
So do you buy Disney here? By the way, credit to you. You bought Netflix, right?
Yeah, I don't want to own both, but Disney probably is way overdone to the downside. I think there's more going on there than just streaming competition. I think there's some travel issues and some concerns about consumer discretionary spending. I think it's a slightly different story, but I
actually think Disney was. Ben and I covered this heavily today. I think it was all streaming. They lost $6 billion on streaming. When you thought that Disney Plus was a savior, it actually killed them, because Warner Brothers, Paramount, Netflix, the streaming companies are all under massive amounts of pressure. Let's look at some of the best and worst performing stocks since the bottom. So this is only a month. It's only a month ago. The market bottomed on June 16th. Okay, and the worst. There's a theme here. Tell me if you know the theme. Apache, Freeport, Conoco, EOG.
I'm sorry. The bottom is.
We can't zoom
June
in, right?
16th. June 16th is the S&P 500's most recent low.
Yeah.
So we got about a month of market activity since then.
Let me plow through this real quick. Apache, Freeport, Conoco, EOG, Marathon, Diamondback, Newmont Mining, Phillips 66.
These are the worst.
Schlumberger, Halliburton, Devon Energy, Pioneer. I mean, you get the point. It's basically all energy.
Anything inflation related is the bottom performing stocks.
It's just energy, and then you throw in Match Group. That's kind of random.
Well, no, Newmont. Wait a minute.
Mosaic.
Celanese is chemicals.
All right, so you got
Newmont
Mosaic,
is gold. So I think it's inflation trades.
Three materials, but all energy primarily. Those are also the biggest winners in the first half of the year. Best performing stocks. There's not as much cohesion there. You've got Moderna, Etsy, and Phase. So I guess you could say just three names that just absolutely got pummeled.
Remember I pitched healthcare a few weeks ago. Like
XBI.
that is the hottest sector in the market right now.
That was a good pitch. Here's where you got some themes here. You got Pulte and Lennar and DR Horton. Okay, good. They got killed too much. It was too much. You've got American Airlines, Norwegian Cruise.
Penn Gaming is bouncing. That's interesting.
Penn Gaming. So yeah, all right. Look at that.
So all right. So these are a lot of those were the worst stocks in the first half. Is the point? And the thing that was killing the worst performing stocks this year was just the idea of like endless rate hikes. And so maybe what we're seeing with the inflation trades reversing to the downside and the hardest hitting stocks reversing to the upside, maybe what we're seeing is the market starting to sniff out the end of the acceleration in inflation.
You think Powell's loving this?
No, his legacy is already like this guy was a year and a half late. I mean, I think he can get us out of this, and then he's going to end up back at a private equity firm relatively soon. I don't think that there's much more really that we need to hear from him at this point. It has not gone well.
The last thing I want to touch on, this is sort of tangential to what we've been discussing. Nick Majuli wrote a piece today, and he quotes a report from CXO Advisory Group where they analyze nearly 7,000 public market calls made by 68 pundits from a period of 2005 to 2012, and they found that their average accuracy was 47%, slightly worse than chance. All right, whatever. This is all people want. I mean,
pundits doing what? What were they doing?
Stock picks, public market calls. So I don't know if it's just stocks, but whatever, public market calls. You know this better than I do, but even
47% is not even that bad.
Yeah, it's not bad. I mean,
because like in the Renaissance book, this is the greatest hedge fund of all time. They're like 51% of our trades go up,
right,
or work out. So like 47% is like about what I would have guessed.
But the point is, at the end of the day, really, it's the only thing people want. I've spoken to friends and people. They're like, I know, you know, but just what do you got? I'm like, literally.
No. All right, there's some nuance there. Intelligent people see the enjoyment in stock market calls, but then also want the context. Dummies just want the call. So I think that there's a little bit but to your point, everybody wants the pick.
Fine, but everybody just wants a stock pick. I mean, really.
But my point is there's also an appetite for more than just here's a stock pick of the day. And that is coming from people that actually want to get better at this or understand why people feel a certain way about something.
I just think, just generally speaking, overgeneralization, people refuse to believe that the market professional doesn't know where the stock market is going. Well, no matter how many times you tell them.
We could spend hours on that conversation. Netflix earnings came out after the close. This was like so widely anticipated by so many people for so many reasons. The first is everybody's a Netflix subscriber and everybody's fascinated by Netflix and the programming and the content and the shows. So it's got a lot of brand awareness. It's like when Apple reports. Mm-hmm. But that's always been the case. With Netflix specifically, this was really the first company to sound the alarm about the consumer having too many streaming services. Like this was the first, I think, large cap tech company to be like, hey, it turns out there's not endless demand. I think they had done 2 price hikes for subscribers, and they finally hit the point where people cancel. And so last quarter, they shocked us with 200,000 subs net quitting. And then this quarter, they were supposed to see a loss of 2 million, but they lost only 970,000. So the stock has been rallying into this number. I'm long, full disclosure. It rallied more. Where is it after the close right now?
224 last time I checked.
So that's a lot. This was 180 a couple of days ago. Mm-hmm. So I know
it was up 11. It
was
up 11% today.
And then another. How much after hours? 20
7 or 8.
Oh, that's it.
What do you mean that's it?
Oh, so the combined day.
I'm sorry. That's inaccurate. That's the total number for today. My bad. It was up 5.5% today, and another 8 after hours.
Okay, it's a pretty big day. Earnings per share $3.20 versus $2.94. Revenue 7.97 versus expected 8.03. I really don't think either of those things matter. I think this entire reaction in the stock was predicated on the sub number. I mean, that was such a big deal to everyone to understand how much worse this company's subscriber base was eroding.
This tells you everything you need to know. It lost 5 times as many subscribers as it lost in the last quarter. And yet...
And the stock's up.
Right. So it was at 190 this morning. It's at 220 in the after hours. There was some interesting stuff in here. I didn't know this. 60% of their revenue comes from outside the U.S. So there was a massive, massive currency impact given how strong the dollar is.
Well, what I would tell you is they seem not to care about the currency impact with certain stocks. Like they didn't care with J&J. They don't really seem to care with this one. Thank God. Because if you think Netflix has currency issues, wait till Apple reports next week. That's one of the most, that's like one of the biggest swing factors for Apple is international business as well. So it's very, very similar situation. They also made some noise about the ad-supported plan, which I think for most people believe will be a potential savior for Netflix. If they've run out of people who want to pay a premium price, maybe there's an untapped market of people who will pay $2 or $3 a month and watch a couple of commercials. I happen to think that'll be the case. I think it'll take a while, but I think it'll work.
Here's a face blower. The minutes viewed in billions, I don't know if this is monthly or quarterly or what, for Netflix was 1,334. Again, I don't know what the number exactly means.
Billion hours?
Billions of minutes. Whatever. It doesn't matter. The point is, that is about as big as number 2 and 3 combined, which is CBS and NBC. If you compare Netflix to Disney, it's 5 times as much. Same thing with Prime Video. So Rich Greenfield was making this point on the podcast with Matthew Bellany, The Town, saying that he thinks that Netflix deserves the benefit of the doubt because it's not about the number of subscribers. It's about the number of minutes viewed or hours viewed or whatever. And as far as that goes, because that's what the advertisers care about, right? They care about eyeballs, not just subscribers. That's where Netflix takes the cake. It's not even close.
Stranger Things generated 1.3 billion hours viewed, just like the new season of Stranger Things. Like
so it said that was the second
massive, dude.
Second biggest, our biggest two season. What does that mean? Of English TV ever. That's a weird word.
They also said that they're going to add a net 1 million subs in Q3. I mean, who knows if they'll hit it, right. But I think that was a relief. And that's versus adding 4.4 million in the third quarter of last year. So it's still decelerating. It's still not great. But
here's what's great.
Alex Kantrowitz was on CNBC right after the close, and I think he made one of the more important points, which is that like Netflix is one of the last things you cancel. Yeah. Like you're gonna cancel Paramount Plus before you're gonna cancel Netflix if the consumer really gets into a jam and has to start pouring over their subs. This is probably one of the stickier ones. I think that's a fair point, right?
The other thing that they have going for it is they're profitable as a standalone entity, where a lot of the others are either not or being subsidized by the parent company. So let's run through some of these charts. This is from The Science of Hitting, an excellent Substack by Alex Morris. Alex will be on TCAF in a couple of weeks. Let's look at gross margins first, please. And we can go through this quickly. Point is, it's a healthy business. They're actually doing well. Free cash flow is positive. The company is doing well. Next chart.
Wait, that's 42% gross margins for Netflix?
That is on, yeah.
Like, there are very few businesses in the S&P 500 that have been around this long that can still talk about any kind of gross margins, even in that realm. Like, it's a very good business, like, objectively, versus every other type of company you could invest in. It's still very good.
So, paid subs, we know that has plateaued, but okay. I think the street has digested that, obviously. By region,
plateaued at a crazy high number.
Crazy high. And they say that there's another 100 million in people that are sharing. So we'll see how much they could tap that. What are we looking at here? We're looking at by region. So as we said, 60% of revenue comes from outside the United States. This is a massive international.
The light blue is US. Light blue is US and Canada. So that is 73 million subs in North America.
And by the way,
not counting Mexico.
That's right. So again, 75 million was the peak in Q4.
Right.
74 in Q1. Ouch. 73 in Q2.
Okay. We got one more on this.
And last one. Okay, so here, this is it. Look at the revenue of Netflix. Again, this is from Alex Morris.
Red is Netflix.
Compared to Disney, compared to Warner.
Gigantic.
Paramount.
Listen, I think Disney is the only one on the board that can maybe catch up.
In terms of revenue? No.
Yeah, but at what cost? Like they're gonna Netflix has such a huge lead. How much does it cost to catch what they've already built at this point?
That's a great point. So Disney burned $800 million last quarter.
Yeah.
And total, it's cost them $6 billion. Now, they're not Apple, right? They're not Apple or Amazon. That is just, pockets that are 15 miles deep. It doesn't matter. They can continue to subsidize. That's not what Disney is.
That's right. They've never been that. They've never been that. All right. I want to do the advertising platform really quickly. So 222 million subscribers globally. And they're going to test this stuff out like in Latin America where they test a lot of things.
They're going to move slow.
And this was a quote from Hastings. And this is a reason to be bullish on them eventually getting it right. Quote, "We'll likely start in a handful of markets where advertising spend is significant. Like most of our initiatives, our intention is to roll it out, listen and learn, and iterate quickly to improve the offering. So our advertising business in a few years will likely look quite different than what it looks like on day one." That's the whole story of this company. They figure shit out eventually. Mm-hmm. And whatever they start off with, mailing DVDs, becomes very alien to what the thing eventually looks like. So the Journal had a piece about, here, this real quick. The company, Netflix is the biggest prize for advertisers because it's 222 million subs. Though it remains to be seen how many people will opt for the ad-supported tier. The company's also seeking to amend its programming deals with major entertainment studios to allow it to run content on the ad-supported tier. So if they bought Goodfellas, in other words, streaming rights, now they might have to go back and say, hey, we also want to run ads during this, which is not going to be a problem. It's a place we couldn't be before, said Angela Zepeda, Chief Marketing Officer of Hyundai Motor America, and we want to be there. There are companies that are dying to get onto Netflix. They know the eyeballs. They know the minutes watched. And I think there'll also be advertising tie-ins on TV shows,
what?
Which is a whole other category. You might see a character drinking a Coors Light or a Corona in a scene. So I still think that this is a dominant platform going through a period of time where they have to get more creative to find growth. I think a lot of people wrote this thing off like it was going to $20, and I think tonight's a tough night for them. So, what do I do with the stock is the question. Do I blow it out tomorrow and then just like reassess, or I really don't have a strong opinion.
I'm a profit-taking type of guy. I don't know.
All right.
But
the wind
is at its back right now. So, all right. Actually, I said to Ben today that I would be in wait-and-see mode. I thought the stock was guilty.
Do you know about the gray man?
I do. I'm waiting.
John, do we have some from this?
Yeah, Chris Evans, Ryan Gosling.
Bro, not for nothing. Like, look, it's
Anna
it's
DA.
Russo brothers. So this could be a big. This is the most money they've ever spent on a movie. This is more than the De Niro movie. Yeah, I
watched the trailer yesterday morning. Looks explosive.
The Russo brothers made the Captain America movies and Infinity War.
Yeah,
and
I did like
Endgame.
Winter Soldier. Winter Soldier is my favorite Marvel movie. Just so you know.
I think they spent $200 million on this. Does that sound possible? Anyway, the Gray Man's record-breaking $200 million budget. First of all, it doesn't matter. But when they do have a hit show, it does drive more subscribers, and it does drive a lower churn rate. People stick around when they like the content. This is still a business where content is king. It's still an entertainment company in the end. It's not really a tech company. So they have to entertain us.
Where are you with episode 6 of The Old Man? Did you like it?
I'm not there yet. I think I'll probably watch it.
All right. You done with that?
We got to move. 5:55.
We don't have to do anything. We're having fun.
We ought to move.
Okay. In March, individual investors, this is from VandaTrack, or Vanda Research, I should say. Individual investors bought $28 billion of stocks and ETFs on a net basis, the largest monthly sum ever recorded by Vanda Research. I'm not sure why we're going back. Okay. March was the record.
Okay. And it's still hanging in there.
Still hanging in. So this is the opposite, the exact opposite of what institutional investors are doing. Institutional investors have taken $258 billion out of the stock market this year. What's
So,
going on?
all right. So, well, first of all, I think it's a push in terms of like who is right. Because if you had been allocating most of this year, you're still underwater. And if you're an individual investor, I was reading the quotes from the investors in the article.
Good quotes.
And like, they're good quotes. The guy's like, listen, it's 15 grand. It's not going to kill me. Like, it's like, here, if I lose 15,000, I'm not going to die. That's it. That is the actual way to think about this. That's the right answer. They say the number of retail trading clients at Morgan Stanley, which owns E-Trade, rose to 7.8 million at the end of June, up from 7.6 at the end of March. And they made an average, I don't know if this is good or bad, they made 880,000 trades a day. So the audience for investing in the market did not disappear. I guess that's positive. On the institutional side, this is odd to me. JP Morgan estimates institutional investors have taken out of the stock market this year through July 5th. Michael, where'd the money go?
Pudgy Penguins.
No, really, where did it really go?
Don't do this.
Is it money? Is it money market funds? Where is it?
You're an
Literally.
asshole.
Okay.
Here's another great quote from Natalie. Natalie Story, a 31-year-old project manager from Santa Monica. She has no fears about the economy because
she's never scared.
She's staying the course. She invests all her extra cash in Vanguard. She said stock markets eventually go up in the long term, and if they don't, we'll all have much bigger problems in our investments. I think that I don't even know what this means, the average individual investor, but I think that most people understand.
Yeah,
most people is a bit much, but people are getting smarter.
Courtney Bowman.
Yeah. What does she want?
When did individual? I like that the Journal is not looking for the biggest idiots. They're actually looking for people who know what they're talking about. This is really cool. Courtney Bowman, 32-year-old software developer. Listen, she has the whole thing nailed. Quote: "Am I buying at the bottom right now? I don't know.
Care. Right.
But I do know I'm buying at a steep discount. It's the classic This is her. It's the classic Warren Buffett mindset of being greedy when others are fearful. We go shopping on Black Friday to get discounts. This is the same."
You would never have seen a quote like that in the Journal in 2000.
No, they used to clown people. Like
Right.
they used to look for imbeciles and quote them and then tweet out how stupid the quote was.
Well, they
This
still
was
do.
a very good article.
They still do that a little bit, but this was a breath of fresh air.
You know what? I'm rooting for everybody in here except the person that's like buying Beyond Meat or something. You're gonna lose. Everybody else, bravo.
Duncan
class
catching
is
some
getting smarter,
shrapnel. Yeah, no. So Ben said that a while ago, and I sort of dismissed him.
I like that.
I think he might be right, and it's great to see. I hope we play a small part in that. You know?
Yeah. All right. I want to mention one thing that I think is a positive. Regardless of whether or not the market keeps rebounding, whatever, I feel like the urgency is gone. Like, people have calmed down.
Yeah.
And that is really healthy. Not that losses are healthy or that we're rooting for, like, things to get busted or whatever. But, like, you should take a beat and, like, think things through. You should not be allocating to 5 startups a day over Zoom. Like, that is unhealthy behavior on the part of pros, let alone what retail investors were doing to try to catch up. So there's a really great article about just like venture capitalists at the beach this summer. If I miss a deal, it's whatever. Venture investors throw in they're basically like, okay, everything sucks. I'll stop investing. I'll just relax. And they don't feel that same pressure that everyone felt last summer to just be invested in everything and pay the highest price and do deals without even looking at the paperwork just to get in. Like, all of that shit is over, and that's kind of how I think it should be. What do you think about that?
Deals have slowed down. I mean, yeah, obviously, right? Like, there's no more FOMO. FOMO has absolutely evaporated, which, good.
FOMO is what, but isn't
agree.
FOMO
Good.
the source of the absolute worst losses? Not the biggest losses, but the worst kind of loss. When you just did something and you don't even know why you did it, but everyone else was doing it.
I had some FOMO holes in my portfolio.
Same.
Who didn't?
Always.
Andreessen Horowitz. Let's show. I mean, I don't know that they're not at the epicenter, but they're pretty close. They did 46 rounds. By the way, that's hilarious. I'm reading this expecting a slowdown. 46. It sounds pretty high. They did 46 rounds in the second quarter.
It's
I'm
lower.
just saying, 46 rounds in the second quarter. That's not nothing. So it's down from absolutely out of fucking control to still very high.
And they've raised funds since last year. So they actually have more money and they're doing less deals.
So how many days are there in a quarter?
No, but Mike.
90?
So like
how many weekdays are there in a quarter? 70? They did 46 deals.
Right. So a lot of this stuff was probably already in progress before the NASDAQ fell apart. But
Yes.
they put $2.5 billion to work in the second quarter. And the same quarter a year ago, or no, the first quarter of this year, they did 62 deals totaling $6.1 billion. Just hear me out on how Captain Obvious. Like the deals that they did this past quarter are probably going to be better investments.
Of course.
Between now, I mean, not everything, but like just generally speaking, when you put less money into a typical deal and you did less deals, it's more likely that you will have succeeded.
So I'm thinking
it'll
about
take 7 years to figure it out.
Crypto. A16Z is big into crypto. Let me get a little teaser. Ben and I finally spoke to Zach Prince today. We had him on for 45 minutes, and he had some good stuff. Here's what I learned.
Is that coming out on the pod tomorrow?
And I learned a lot. I learned a lot. No, Thursday.
Thursday, okay.
Did you know that they have the option to buy themselves back or step ahead of FTX? So that FTX deal can't close until October next year. They have the option to buy it back.
Okay. So in other words, if things are becoming better than expected, the fire sale is not like definitely going through. So there's
they would have
a universe
to pay a
in which they survive as a standalone company.
They would have to pay a premium to what FTX offered, but it's not done.
Zach seems like a really nice guy. What's his whole vibe like right now? Is he like getting in touch with himself and like?
No. He's not. No. Personally, I am a huge fan.
Usual.
I am a big fan personally, and that will come out on Thursday. So stay tuned for that.
I'm saying he's like working shit out. He's not in an ashram. He's not in Tibet.
Like he's not tweeting quotes. No,
right.
He's working.
Okay.
He's getting through this.
The tweeting quotes is not great. Okay.
All right. So maybe this is a little bit dated, but I don't know that everyone's bearish, but institutional money managers, as we had just laid out. Let's look at these charts.
When did this come out? This is Savita.
I saw this yesterday. I saw this yesterday.
Okay.
Or maybe this morning. Okay. Bank of America Global Fund Manager Survey, which we're looking at the net percentage of investors that are taking higher than normal risk levels. Now, I understand surveys.
That's a weird way to look at it.
No. Surveys can be weird, but like this is not watch what they say. I don't think. I would expect that they're doing what they say in this case, but look how freaking bearish people are. Just look at this.
But why would people be like, I'm taking higher than normal risk levels? It's not
fine. But next chart. Net overweight equities versus cash. I'm sorry, John. Previous chart. Just on the bottom. Focus your eyes on the bottom.
Okay. What is this now? Net percentage.
Let's say that they are overweight equities versus cash.
What's
it's the same
AA?
thing.
This is American
asset allocators, I guess.
Oh, asset allocators. Say they are overweight. Okay. All right. Yeah. Listen, it's washed out. Sentiment is washed out. Cash balances are way higher. Strategists are. Like the types of strategists that put out like their allocation, super bearish equities. We're definitely in rarefied air. I guess the question becomes, how much of it is justified? I feel like a great deal of it is justified.
Oh yeah,
and yeah,
there's reasons. It's not people aren't hysterical for no reason. There's reasons.
It's not random. And by the way, when you hear about institutions doing a big amount of selling or whatever, like a lot of that is because they're being redeemed. It's not like they keep the money. If you're an institution, it's someone else's money. You don't get to always keep it forever. So I don't think there are huge redemptions, but it's possible that there will be, and you could see selling ahead of that, and it might have nothing to do with an institutional manager's opinion of the market.
True.
And we have to always remember that.
Did you listen to J.P. Morgan's earnings call?
I think I listened to just the boilerplate up front, like just the stats, not the Q&A. Yeah.
Okay, because Mike Mayo, there was a really, really good part where Mike Mayo was like, all right, Jamie, I'm confused. You're telling us that a storm's coming, but meanwhile, you're out like you're boating, you're buying kayaks, you're buying surfboards. What's going on?
Yeah.
And Jamie was like, I'm telling you that the consumer has never been in better shape. The corporation has never been in better shape, but I'm just telling you that things are, we're also investing for the future and things things are questionable right now.
Remember
it was really good.
Remember we had that conversation about like the perma bears and like how when they nailed the call in '08, it was like the best year of their lives.
Yeah.
They did like the speaking circuit. They got paid to talk.
Milked it for a decade.
They got on like Good Morning America. Like they crossed over. It was beyond CNBC Bloomberg. Like they were on with like fucking Stephen Colbert and Jon Stewart.
Peter Schiff was on the Colbert Report.
So
with Barry, 2013.
Right.
14.
So if it's easy to understand why somebody who becomes famous for saving the day before a bear market or getting that, it's easy to understand why they see that next bear market everywhere, because it's like the best years of their life. They almost want it back. I don't think Jamie Dimon wants it back, but I do think that he came out of that shit heroically. And if it happened again and he were ready for it, like it wouldn't be the worst thing for him. Yeah.
Right.
Like I feel like he would look in the mirror, breathe in deeply, and be like,
it's my time.
Still got it.
It's my time.
14 years later, still got it. So there's some element to that there, maybe.
Last chart here. This was interesting. Probably also peaked at this point, but the defensive price momentum is in rarefied space. What we're looking at here is a percent cap weight of defensive sectors. That is staples, healthcare, and utilities in a high at 12-month momentum. And again, look, I mean, this is not what you want to see typically, right? This is not off the charts quite, but this only happens really during and around recessions.
Counterpoint. This is exactly what you want to see if your time horizon is 12 months or longer, because this never lasts. It's just, I'm sorry.
My point is,
yeah.
we don't have the gray bar yet. Look, those spikes always happen in recessions.
Hey, one thing I would point out is that there was a time when staples were also the growth companies of America, and that time was in the 1990s. And it's happened before. But like in the 90s, you had staples that were growing faster than the overall market. Like Coca-Cola was in its heyday, like its growth heyday in the 90s. So it's like, it's hard to parse that out, but utilities, really there's only one reason why those become momentum stocks, and that's people fleeing from
This is
from
not
risk.
hard to parse out. These stocks rip during recessions. That's it.
Fair enough. All right.
Next.
Last thing we're going to do tonight before we get into viewer topics. One hedge fund seemed to have figured out the key to the year. They were early, but they were shorting tech and growth stocks, and this is what a hedge fund is supposed to do, in my opinion. Like, I'm not of the mind that a hedge fund is supposed to beat the S&P by 2%.
I agree.
That is to me, I don't understand why you would pay for that. This is what you should be paying for, and you should understand that it ain't going to happen all the time.
The butt bot. This fund lost 56% in 2020.
Well, so I'm going there. Hang on. If you own a hedge fund, theoretically, at least classically, the idea was that it's meant to hedge your real portfolio. Like, the hedge fund's not supposed to be most of your assets. It's an allocation that zags when the market zigs. So losing 50% in this hedge fund in what year?
2020.
2020. Fine. You fucking made money in everything else. That hedge fund was hedging. The hedge lost. Congratulations. The good news is everything that wasn't the hedge went up. All right, so this is a fund that basically did this right. Gained 19% in 2021, but it only had $200 million left. I guess people were unhappy.
Down from $1 billion.
Down from $1 billion. And then tech stocks plunged. Coltrane is now up 223% this year through June, according to people familiar with the matter. The total gain in dollars is several $100 million. I just say, like, I could never do that job, but to somebody that's done it well, I tip my hat. Pretty great.
From 2012, it did 19% a year on average.
Oh, yeah. No. But listen.
It's amazing.
And it doesn't look like the S&P.
Well, it's lumpy. Lumpy returns are tough.
Lumpy returns, but lumpy returns are like the best hedge funds of all time.
Correct.
When you look back at their returns, there were market environments where they made you fucking miserable. But that's the only way you could make several $100 million on $200 million in any given year. You have to look really different than how everyone else looks. So it's just nice to see that this kind of thing is still out there. The guy's 38 years old, and he's British, and he's probably not on stock twits or being a dick on Twitter all day. The guy's just head down, doing his thing, probably writing his letter, and living his life, and pretty cool. And anyway, that's all I want to say about that. What do you think?
Duncan,
Thoughts?
get in here. That's what I think. You ready? I already shared my thoughts.
Hey,
Okay.
guys.
What's up, Duncan?
Hey, Josh, do you know how much Beyond's up over the last month?
This fucking guy. Go ahead, tell me.
57%.
Really?
Yeah, I'm still down 70%.
How much did you tell me to buy?
None.
So ETH is up 57% over the last month. By the way, Duncan, hold your shut up. You're repping ETH today?
There
I don't
we
think
go.
these are for sale in the shop anymore.
Okay.
No,
But
we
ETH
discontinued them at the bottom.
Yeah, okay. ETH is down up 57% of the last month and down like 60% of the last 3 months or something like that.
What's
Holy
going
moly.
on? Wait. What's going on with Beyond? Look at this. What's going on? Did they say something good?
Yeah,
Or
it fell
just
90%.
Well, keep
That's
in
what
mind
happened.
it was over $200 at one point. So
Right. All right. What do you got for us today?
okay,
Let's do it.
So up first, we have a question from Mark. I have a question regarding some of my big losers of the past year. Palantir, SoFi, Matterport are a couple examples they gave. They're all down around 50% from where I bought them. With everything having fallen so much and having held on through the turbulence so far, if I still believe in the long-term stories for these stocks, would you suggest getting out now and moving to something safer, or sitting through and ignoring them for now? None are larger than 5% of my account.
Okay, so I did this with Roblox. I'm in Matterport. I'm absolutely buried in it. I don't have enough that it's like really going to affect me. But percentage-wise, I'm buried in it. That one I'm going to leave. But like Roblox had a huge bounce off its low. It was 20. It ran up into the 30s. Now I think it's up to 40. But this was a stock that I bought like right at the tail end of the mania, and no stop loss. I violated everything that I claimed to stand for. So I basically use that as a virgin sacrifice. Sometimes you just got to throw a stock into the volcano. This is science. What I'm telling you. Sometimes you just have to throw a virgin into the mouth of the volcano to put an end to the curse. So I did that with that one particular stock. I blew out a couple of others, but then I have some shit that I'm just like, whatever. It's not going to make me money this year, but I cookie jar it. So what I mean by cookie jar, if you're doing this in a portfolio and you're not doing this algorithmically, you're going to need some losses, especially if the whole market recovers. You're going to need some tax losses. So keep it in the cookie jar. If and when you need a tax loss, that's when you go ahead and make that move. I wouldn't just win. If you held something that fell 50, 80% and you haven't sold it yet, like what's the difference at this point? So anyway, that's how I would answer that question. What do you think, Mike?
The only thing I would add to that, and that was very well said, is that forget about all-time highs. Those were completely...
throw out your old reference point.
Those weren't real, okay? So I understand, it was 400, now it's 70. Forget about 400. It's 70, okay? So do not try not to anchor to the fake high. All right, next topic.
Yeah, that's hard to do. You want to see those previous.
Of course it is. By the way, what's
nobody wants to book a loss ever. Of course, it's
what does that
human
hat
nature.
say? What does that hat say?
Oh, it's my Formula E hat. I went to a race over the weekend. I'm now a Formula E fan.
I like how it matches the
it's like
it looks
I know,
good,
yeah.
dude.
The sound
same-
panels.
good.
Same
Yeah.
hue and everything. All right, topic 2.
Okay.
From Sam.
Up next, we have a question from Sam, who writes, I own some Apple shares, but I want to buy more. I know the smartest way to buy more shares is to dollar cost average, but let's say I also want to lump some shares at some point this year or next. What are some signs in the economy that could tell me it might be a good time to buy? Is it a drop in CPI, something the Fed does, or something else?
The economy can never tell you when to buy or sell, especially when to buy, because the stock market will bottom. I'm not making this up. Who had this research? Was it Adam Parker? I can't remember. On average, the stock market bottoms 140 days before the economy. Before the economy turns, something like that. The stock market will bottom way before the news stops getting bad. In fact, we might be there right now. The news continues to get worse and worse, and stocks stopped going down a month ago.
I would just say though, Apple's going to report at the end of next week. You might miss out. Like they might have a great earnings report, and the stock runs up $10, and then you'll be like, "Shit, I missed it." But if you really like Apple, then you won't care that much. But there is the potential. Apple, I would say once every 4 or 5 quarters has a shocking report. And by shocking, I don't mean the company's falling apart, but they throw a lot of kitchen sink stuff all at once. And there's always that one moment where like Apple has that big decline. I'm not saying it's going to happen because of earnings. Maybe the earnings report will be great. Who the hell knows? I'm just saying, like, buying it right before the earnings presupposes that you have some sort of an edge on it. I don't think you do. I definitely don't. If you don't think you do, maybe it would be better to trade the reaction as opposed to anticipating. So, like, just one thing I would say is maybe you'll miss out, but, like, I just wouldn't buy it right before the earnings if I didn't feel strongly on what the earnings report would be. Just my 2 cents. What do you think about that idea?
Actually, I wasn't listening, but actually, Apple yesterday said that it slowed hiring, right? No firing. It slowed hiring, and the stock went down in a straight line after that report.
It's since recovered all of that.
Got it all back.
I asked Sean to take a look at this. Today is the 50th day that Apple's been beneath its 200-day moving average since it's broken below. And the average amount of time it's spent beneath its 200-day over the last 10 years is 33 days. Remember all those V-shaped recoveries for Apple in the overall market. So it is now below that 200-day moving average for almost twice as long than it's historically been over the last decade. So I'm not sure that means definitively something has changed here. But clearly this is not a V-shaped recovery for the stock, which means maybe you have some time.
Yeah. Stock looks okay. I was very excited for Netflix's earnings tonight. I think that the streaming wars is one of the most interesting, exciting topics in the market right now.
You know what? It's as entertaining as half the shit they actually put on Netflix. So it's like there should be a show on Netflix about the streaming wars. All right,
joke that would probably do really well.
I think they're going to do it one day.
Josh, before we get out of here, where are you on the movie Swingers?
Classic.
Okay, agreed.
It's on my like indie breakthrough director classic list with like Clerks and like I got a list of those. Most of them are from the 90s and 2000s.
Reservoir Dogs. So it's on HBO Max. I saw Swingers when I was like 12 years old, and I completely didn't get it. Obviously I was 12, right? It's not for 12-year-olds.
You weren't dating.
It's not for 12-year-olds.
No.
I randomly rewatched it like a couple of days ago, and it killed me.
You know what really holds up, and I think is a better movie because they had a budget and they had some time to really be creative? Made.
I never heard of it.
Jon Favreau and Vince Vaughn. It's the follow-up to Swingers, but like with a budget. Diddy is in it, and it is explosively funny. They're like
I never heard of it.
I haven't seen that.
They're like hitmen from LA. They come to New York for a job, and they have no idea what they're doing in New York. So it serves as both an ode to New York, a great Vince Vaughn performance. Favreau is aces as always. Diddy is hilarious. You got to find a way to watch this movie today.
Okay.
How do you not know about this?
I've never heard of this.
You'd love it. Oh, you would love it. All right, so say we all learned something tonight.
Okay.
Hey, guys, make sure you are subscribed to the channel if you're not already. Make sure that you have hit that like button if you haven't already. We so much appreciate all of you who came to tune into the live. So great to see everybody. We will see you next Tuesday night.